Friends, today I am removing paywall from one of my exclusive video that I have discussed recently. This was the 241 video of my weekly video series that I started nearly 4-5 years ago. And honestly, it's been a roller coaster ride. However, the biggest takeaway is the learning from each and every event. And that has set a solid foundation to invest with confidence. Because I always say that India is one of the fastest growing economies in the world. And if our nominal GDP growth can be 9 to 10%, which I believe is very much possible, then India would become a $35 to $40 trillion economy in the next 25 years. That's a simple math. We have been able to grow at this rate in the last 25 years, and I firmly believe that we'll continue to grow at this rate because of our demographic dividend. So there's a massive wealth creation opportunity. Yes, the journey won't be smooth, but corrections will only create buying opportunity for India. Now coming to this particular video where I've removed the paywall, the reason is because I've discussed a very important topic on valuation, that is PE ratio. Because PE is one of the most misunderstood metric. So I've taken a detailed session in my 241st video discussing how to check valuation. And then I thought it's better to share it with a larger audience on YouTube. By the way, I also discuss a lot of other things in this weekly series that include my own investment strategies, like what I am buying or selling, and most important, the thought process behind the decision. Again, if you are looking only for stock tip, this weekly video series is not for you. The idea is simple. There are many people who are interested in stock market but do not get enough time to track the key events like government policies, geopolitical event, or even quarterly results. And that's where I try to add value as I spend many hours on a daily basis tracking the market. Eventually, I want you all to learn from the series and build your own thought process so that you can yourself decide how to construct your portfolio. So let me share this weekly video series with you all. I hope you will find it useful. Hey everyone, welcome to 241 video of this weekly video series. In today's video, I want to first discuss the market outlook. So I have outlined a few important points that I've already shared in the community post. I want to quickly touch base on that. Second, I want to discuss a very interesting parameter, PE ratio, and there are actually 8 variables that decide which company should command what kind of PE multiple. Because PE is a very abused metric. People usually use PE ratio and figure out whether its company is cheap, whether it is overvalued or whether it is fairly valued. But then you can't just look at absolute PE number and say whether it is cheap or not. Right? So what are the variables that decide what kind of PE ratio a company should command? Right? So we'll discuss that, very interesting one. And then third, I want to discuss the sectors, themes and specific stock where currently market is bullish. See, there are two approaches to invest your money in a falling market. One is your momentum buying, right? So identifying companies that are falling the least, right? They're still holding a lot of, where basically your correction is least, right? Where there's a lot of strength in the share. Right, so that is one way, which is basically momentum. Now, what is momentum? Where the companies are doing exceptionally well and the expectation is that they would continue to do so. Right, so, and that is the reason when the market is falling, those companies are falling the least. Then usually what happens is people avoid these kind of companies. They look at only those companies that have fallen the most. But my experience suggests that in a falling market, it's better to look at companies that are showing a lot of strength. Because those will be the one to recover most quickly and jump a lot when the market would recover. And so that is one approach, which is momentum buying. Second approach is of course the value buying, right? Where the correction is there, but then the problem is that earnings are still struggling and the share is falling a lot. Right? So in this particular video, I want to focus on the companies where market is bullish on, or themes or sectors where market is bullish on. And of course, how do you really identify stocks that are showing strength? There's a very simple way that I'll show you in this video. All right, let's get started. Just a quick disclaimer, this series is only for educational purpose. The idea is to share my knowledge with you all so that eventually you build your own thought process in terms of how to build your own portfolio. Right? Because I always say that nobody should depend upon someone else for the rest of their life. Right? So that's the entire idea. So let's first start with the market outlook. So here I have identified a few important points. First of all, if you look at the Indian stock market, there was a massive rally between April 23 to September 24. If you look at Nifty 50 or let's say mid cap, small cap, look at this. There was this period, June 22, it rallied, then it corrected. But then after this, 24th March 23, there was a one-way rally, right? From levels of 17,300, it jumped to 26,000. This is Nifty 50. Then if you look at Nifty mid cap 150, your same story from 11,100 on 24th March, one-way rally started, ended till September. So nearly your 16, 17 months of one-way rally, and it actually doubled during that phase from 11,000 to 22,000, right? Doubled in 14, 15 months. And likewise, your Nifty small cap 250, it generated even higher return. From 8,700 on 24th March, look at 18,000, more than 100% return in those 15, 16 months, right? And that was the phase. If you look at the valuation point of view, your small cap was at 17 P multiple and it zoomed to 35 P multiple. So what happened during this rally? Your market became very expensive, right? But then what has happened is in last 18 months, since these highs of December 24, in fact, your October, September 24, there has been a one-way correction. Of course, it corrected sharply during this first half of last year also. Then it recovered and then again started falling. But if you look at the from valuation point of view, the majority of growth has been removed. Your Nifty small cap is at PE of 25. Nifty mid cap 150 is at PE of 31. And if you look at it, PE ratio also from highs of nearly 36. In fact, from the highs of 44, 45, it has fallen to 31. And large cap was never too expensive, but broadly your mid and small cap that became too expensive in last rally have corrected significantly. So all in all, now I can easily say that market at a broader level is not expensive at all, right? The froth has been removed. Now, can we say it is cheap? No, it is still not cheap. It is fair, right? So the froth that was there since last 18 months, only that froth has been removed. But the good thing is that from here, the risk reward become favorable because the valuations are not very expensive. Now, still why market is falling is that's because of the war that has happened. And what happens is during the war, obviously there's a lot of uncertainty. The biggest uncertainty is due to oil. So I'll just come to that. So what happened is, one is market became expensive. Second thing what happened is earning growth also reduced in last few quarters. And obviously when the earning growth fall and the valuations are high, your correction is inevitable. But what has happened is positive thing. In Q3, we have seen a good recovery in earning growth, especially your mid and small cap have shown excellent recovery. And I hope this trend continues. Then what happened is FIs have been a massive seller. I don't need to show you. We have been discussing, right? FIs have been selling from India. Earlier, the selling was, what was the reason for selling? During this phase, Indian market became extremely expensive. And compared to that, see, when FIs invest in India, they basically look at the emerging market basket. Within that, you have China, you have India, you have Taiwan, Korea, and so a few other countries. Now, what happened is during this phase, Indian market became very expensive, but Chinese market was ultra cheap. So a lot of money started flowing from India into China. And when China market started giving decent return, what happened is AI theme started. And your South Korea and Taiwan became biggest beneficiary of this theme. Taiwan has your TSMC, one of the world's, in fact, the world largest semiconductor company. Everything depends on that. The NVIDIA GPUs, they are manufactured there. South Korea, your Samsung, SK Hynix, these two companies have immensely benefited. So these two countries were the sharp beneficiary of AI boom. Their index was very cheap. If you look at these markets, at your PE ratio of these markets, 2 years ago and today, now what has happened is the gap was massive and now the gap has reduced a lot as compared. So India, if you look at it, Indian markets are trading near historical median, and now Korea and Taiwan, in fact, Korea has doubled in last 1 year at a market level. Imagine the kind of crazy growth that has happened. So what has happened is now they're trading much above median valuation. Having said this, these two countries would continue to do well as long as AI theme is intact, because they are the strong beneficiary. Having said this, valuation point of view, now the gap between India and other emerging market has reduced, which means FI should reduce selling in FY27. So that's purely from valuation point of view. Second, as far as AI theme is concerned, I believe that it is already overstretched. Again, although for 26, there's been a massive growth guidance, hyperscalers are investing billions and billions of dollars. So 26 looks like this AI theme would continue. But then at some point in time, it will, the growth will reduce, right? You cannot continue to grow at crazy rate. I've been saying that this AI story is similar to what happened during internet boom, right? And at one point in time, internet became a commodity, right? There was a massive investment. Eventually, internet became a commodity. And when the dot-com bubble burst, stock tanked 80-90%. The good thing is that when that AI bubble would burst, India won't would be impacted negative. Of course, there are specific companies, data center related companies, they will be impacted, but not general, because India is broadly missed this AI race. We are broadly driven by consumption, and consumption is more structural theme, right? So 150 crore people will continue to consume. So consumption is a structural theme, and India would be a reverse AI trade. What it means is whenever you will see correction, I don't know when, maybe in 26, maybe 27, whenever AI correction would happen, the FI money would go back to India, right, as a reverse AI trade. Right, so from valuation point of view, I think the gap has reduced between India and emerging countries. So the flow that was there, right, people, they've sold billions and billions. So I think now that should reduce. Of course, now we are into war, so the situation has slightly changed. But broadly, I believe that from AI perspective, from valuation perspective, situation has improved a lot. And I've already discussed AI thing also, that eventually when AI bubble would burst, India would be a beneficiary as a reverse AI trade. Now, what I was saying, consistently was that I was expecting that majority of negative news is already discounted in budget 26, and I was expecting market to bottom out at that level. But then what happened is, I've always been saying that you cannot predict market 100% in the near term, in next 6 months and 1 year, because there are a lot of black swan event that can happen. What is the black swan event this time? Iran, Israel and US war. And because of that, your crude oil crazily jumped, and India has massive dependence on crude oil. We import 85% of our crude oil. And what has happened is, if you look at it, massive jump in crude oil, obviously it is going to impact everything in India, right? Your transportation become expensive because petrol, diesel prices goes up, your import, your input prices goes up. Everything depends upon oil, right? And what happens is, when that happens, government also, RBI cannot reduce the interest rate, right? So in that case, your liquidity gets dried up. And what happens is, because of that, your earnings get impacted, right? And that is what is market is trying to factor in at this point in time, and that is the reason market is correcting. So I'll give a simple analogy. Similarly, what happened between Russia Ukraine in 22, crude oil jumped from 80 to $110, and purely because of this, your index, large cap index, fell by 12%, mid cap 15, small cap 20, right? And that correction lasted for 4 months. So again, nobody knows what exactly is going to happen in this particular war, but I don't think that this is going to end in a few days or week. At least crude oil price won't get impact, it won't fall sharply. Let's say even if the war ends over next 1 week or 2 weeks, obviously the kind of supply that has been disrupted for crude oil, it will take some time. For crude, maybe it will continue to go up and then eventually it will fall, but it will happen over a period of a few months. So I don't expect sharp recovery in market. In fact, I believe that this next 1, 2, 3 months can be a good opportunity to consistently, systematically add stocks. Again, I think this is the worst phase. Like, I think the moment market would bottom out because of this war-related thing, I think from here we can see a very good sustained bull market. Having said this, there is no black swan event, right? Because that is something nobody can predict. But the good thing is that now valuations are decent. The only bad news is the crude oil is not looking good. So that is what is concerning the market. So that is what I've said, that if crude oil crosses $100, if sustained during, at those levels, we can see 10-15% correction, and that is something that is not in our control. However, like I said, this is the last phase of correction before we see next wave of rally. Single biggest factor to watch is crude oil movement. At the moment, if you have cash, the best approach would be to buy in parts, 3-4 parts spread over 2-3 months, as per your convenience, whether you want to buy in 3-4 parts, 6-7 parts, 8 part, 10 part, but try to spread it over a period of a few weeks, right? 1, 2, 3 months, okay? No need to hurry. And avoid too much social media narrative, avoid looking at your portfolio too much, because that is only going to create panic, right? And like I said, nobody knows what's going to happen in the next 6 months. I am 100% confident that Indian market is going to touch a new high in next 12 to 18 months, right? So if you have that kind of horizon, nothing to worry, right? Nothing to worry, trust me. And I've been saying that we have seen so many wars, so many crazy things happen in the last 25 years, but look at the wealth that has been created. Right? And there's only one way. I mean, apart from equity, I don't see any other great option that can create, compound your wealth at 12, 13, 14, 15%. Right? So, but then it comes at the cost of volatility. So you have to bear that. Right? So that's my take on the overall state of market. Now let me discuss a very interesting document that I found, which is a primer on P ratio. Okay. So the author is saying that there are basically 8 factors that determine what would be the P ratio of a stock. Okay. What are those parameters? One is stability. Second is growth. Third is dividend. Fourth is return on invested capital. Fifth is leverage. Sixth is proportion of non-operating asset in company's asset base. Seventh is financial community's appraisal about the industry and the company, including its manager. And last is interest rate. Let's understand it in detail, okay? So the thesis is simple. See, what people usually say is that a stock at P of 5 is cheaper than stock at P of 100, but that may not be the case. A stock at P of 5 may be quite as expensive, it could be expensive as compared to a stock at PE of 100. So you can never compare absolute number PE of 5, PE of 100, you cannot do that, right? So how do you decide like which company should command what kind of PE multiple? Of course, you cannot learn this overnight. You have to spend a few years to gain experience, understand what kind of valuation market give to certain sectors, certain companies within that. It will take its sweet time, right? It won't happen immediately. But that is what you got to learn as an experience. And I always say it's been 10 years for me in the market, and I believe someone who want to invest money in individual stock at a bigger scale, a person need at least 10 years of experience, or at least 5 years is a minimum you need, like before investing your money. What happens is in every bull run, new people enter into the market. They have no idea about valuation, no idea about fundamentals. They simply deploy money, right? They're chasing return. Right? But then trust me, I mean, now you all would know like how correction happens, how people panic, how people lose money, right? So you need experience. It's not just about knowledge, it's also about experience. That's why I say that if you're following the series, follow it for a few years, 2 years, 3 years. Don't blindly buy or sell what I am doing, but try to learn what I am teaching, right? Based on my experience, based on my research, the kind of knowledge that I try to share, there's a lot to learn from that. And that will help you build your knowledge base and make you over the long term as an investor will help you in your journey. Now let's understand what are the factors in deep dive, okay? So one is the stability. See, understand that market will always reward stability. So a company which is growing at a stable rate, what it means is stability comes in 2 ways. One is the stability in terms of revenue growth. Second is stability in terms of operating margin. So operating margin is very important because some companies can grow its top line revenue at a decent stable rate, but the margins can be extremely volatile. Market do not like that. Market will never pay a high P multiple to companies where the margins are extremely volatile, because that means they are essentially commoditized company. I'll give you a great example. In fact, there are 2 companies from same group, okay, and how they command different valuation. Look at this, very interesting. So there's this company which is growing decently top line, like although it is volatile. So 2014 it was 148 lakh crore, then it fell down to 100 lakh crore in 16, then it recovered, then again fell down. But net if you look at it, it's a decent growth. Again, nothing exponential, a decent average kind of growth, not very volatile, okay, although it is volatile, like 50% fall, but then it is not that crazy volatile. But look at the margin, 11%. Fell down to 2%, fell down to -1%. At one point in time, it was doing 16,000 crore profit. At one point in time, it became minus 600 crore. Then at the peak, it touched 29,000 crore. Then it fell down to 17. Then it touched 30,000, 63,000 crore profit. And then it fell down to 32,000, 22,000 crore. Look at the crazy volatility, 26%, 13%, 10%, 12%. What is this? Market will never pay a premium because look at the impact. At one point, you are delivering a net profit of 17,000 crore. Before that, 3 straight years of losses. Then, at one point in time, 8,000 to 41,000 crore. Then again, losses, right? Market will never like it because this is not an example of stability. Which company is this? Can you guess? This is nothing but your Tata Steel. So if you look at Tata Steel, this is the reason. And why? Because metal is essentially a commodity, and that is the reason I avoid metal. Although I always say that if you can time the cycle, because currently obviously looking at it, it started, upcycle started since last year itself. Metals are in sharp rally, and you can see from 150, Tata Steel 198, great. In fact, even in this weak market, metal is doing well. But I don't invest, because that's my thesis, my philosophy. I avoid extremely volatile company like Tata Steel, because I cannot time the market, right? Because when you will see the downturn, it will be brutal. There have been cases when, from the peak of 73, it fell down to 29, 27, right? And I avoid these companies. First reason is the extreme volatility. Second reason, when it is extremely capital intensive business, you have no ROE, no ROC, and that is the reason I avoid Tata Steel, or for that matter, any metal company. Then look at this very interesting example again. Look at the consistency in growth. 10,000, 11, 13, 16, 19, 21, 28, 40, 51, 60, 75. Consistent growth in revenue every single year, almost every single year. Consistency in margin, like 10, 12% in between, of course, 1, 2% here and there, that is fine. But look at the growth, 700 crore, 800, 1100, 1400, 2000, 3000, 4000. Amazing, isn't it? Which company is this? None other than Titan. That's what the company is. And look at this. Look at the valuation. It never commands cheap valuation, 77 PE multiple. And if you look at Tata Steel, I'll just show you Tata Steel PE ratio. It is at 25. And if you look at the valuation, it never commands. Look at the median valuation 5-year. 10-year median valuation is 11. Market will never pay a high PE multiple to volatile company. Market will always pay a high PE multiple to stable businesses, right? Where the margins are stable, where the growth is stable. It may not be extraordinary, but even if the growth is stable, if the company is solid, market will always pay it a high PE multiple. So that's first thing. So that was the example, Tata Steel versus Titan on stability. Next is growth. Market will always reward companies that are growing at a faster rate as compared to companies that are growing at slower rate. So you can never say that a company at PE of 40 is expensive as compared to company at 30, because a company at 40 may be growing at 25%, whereas company at PE of 30 may be growing at only 15%. In that case, obviously the company at PE of 40 is cheaper. As you can look at PEG ratio, right? So obviously it's a no-brainer. High growth means high valuation. A great example, look at this. The company has grown at 22% compound rate in 10-year earnings, okay? 5-year compounding 27%. And as a result, look at and by the way, which company is this? Superb growth, look at this. Which company is this? TVS Motor. So I'll give you TVS Motor versus another company from the same space, and look at the valuation re-rating. At one point in time, it used to trade at 25, 20 P multiple, and then 30, 40, 50, 60. P re-rating happened. Why? Consistent growth from 20s, 40s, 50s, earning kept on compounding. As compared to that, look at this particular company. Like the growth has been decent, 15% CAGR, 11%, nothing extraordinary, but the decent growth, okay? So, and again, which company is this? This is your Bajaj Auto. Its P ratio is 30. TVS commanding 60 P multiple, Bajaj P is 30. How do you say that which one is cheap and which one is not? You can't say that TVS is very expensive, Bajaj is cheap. No, because Bajaj has not grown, is not managed to grow at that level. TVS has managed to grow. So always market rewards growth. But then the catch is the growth has to be consistent. You cannot expect growth to happen for 1 year, 2 years, and then you fall, right? Because rate of change is very important. So next I want to discuss is rate of change. So what they're saying is, when investor expectation about the growth prospect of after-tax earning of company are revised due to some development, PE multiple of stock will change. This makes investing in growth stock which are already selling at high PE multiple very risky. Understand, very, very important point. What they're saying is, let's say today company commander is growing at a fast rate. So obviously it will command a high PE multiple, but the moment growth changes, the moment growth falls, PE will derate. Likewise, vice versa. If the company is growing at, let's say, 15%, and if the growth start to compound at 20-25%, they will be re-rating. And opposite, they will be de-rating if the growth. So rate of change is very important. A great example is this particular company. Rate of change. I've been saying growth has been extraordinary, right? Look at this. 1200 crore, like 200, 300, 1200, 1800. Extraordinary growth. But what happened? Share fell down 50%. Which company is this? Dixon Technology. What happened? Similar thing. What happened is that at one point in time, the growth was extraordinary, but recently in this quarter, growth fell down significantly, and the moment growth fell down, market sentiment was also negative. P ratio derated from 200 to now at 45-50. Why? Because of rate of change, right? So always remember, when you invest in a company that is growing at a fast rate, you got to ask, how sustainable is that growth? Like I've been saying, I've discussed it multiple times. You cannot expect a company to grow at 60, 70, 80% earning growth for years. There may be phases 1 year, 2 year, 3 year. And yes, if a company is small and there's a strong tailwind, it can compound at that rate for a few years. But that cannot happen for 10 year, 12 year, 15 year. And that's why you need to track the business very closely, especially when you're investing in high PE multiple company. One of the great example is Netweb today. So the growth has been extraordinary. In fact, this is even more than what management has guided for. Management was saying will compound at 35, 40%. Growth happened 80, 90% in this quarter, right? So the growth was even more than what management guided and more than what market was expecting. What happened? The growth in share price extraordinary. 5 years, crazy growth. But then the problem is market is paying a PE of 100 multiple, right? So as long as company is able to grow at 40-50%, it will command that kind of PE multiple. But the moment growth will slow down, which may happen in 26, which may happen in 27 or 28, I don't know, right? But at one point in time that will happen. Till that, till the company grows at that rate, it can command at this kind. So that is the risk, right? When you invest in high growth company, you got to understand the risk, and the risk is rate of change, right? So that's the example. Then there's another example of this particular company. Same thing happened, growth was extraordinary for 5 years, but then it suddenly fell down in trailing 12 month. Which company is this? By the way, this is your Tata Elxsi. So Tata Elxsi, same story. There was this phase during COVID when the growth was extraordinary. And during that time, what happened is market re-rated it. So if you look at it from during COVID, it used to command a PE of 19, 15 during COVID lows. Before that, it was at 19, 18 PE multiple. Look at the re-rating happened because of massive growth. And the moment growth fell down, it fell down to PE of 42 now. Same, there are hundreds of examples. Look at your trend, same story, right? So the point is simple, rate of change is important. If you are paying a high PE multiple, the company better should grow at high rate, because if that growth falls, you can, and that is the catch with momentum companies. When the growth falls, stock can derate quickly. 40-50% fall is not a big deal. Then very important point is market also look at return on invested capital. Very, very important point, ROE, ROCE. Like there's an example that we have been discussing. If the return is higher, 15% versus 20%, market will always pay high PE multiple to company that is giving a high ROE and high ROC, right? A great example is this company, ROC 42%, ROE 32%. Of course, you got to look at over a period of time. Can't look at just standalone number. But which company is this? Market cap 25,000 crore, commanding a PE of 54. Even in this market, company is CDSL. Although the growth has fallen, right? CDSL growth in last 1 year has fallen badly, like minus 14%. Still it commands a PE of 50. So you cannot expect a 25%, 25 PE multiple for CDSL. That won't happen. Because A, of course, massive growth potential. B, massive return generating capability, completely debt-free company, right? So always remember that. There are a lot of other examples. Look at this company. 95% ROCE, 83% ROE, completely debt-free, 2.4 lakh market cap. Which company is this? Nestle. It always commands a premium valuation because it has massive ROE, ROC and massive cash generating capability. Okay, so that's another example. Then you have got few more examples. Another important parameter, leverage, debt to equity. Ideally, companies that have negligible debt will inherently command a higher PE multiple as compared to companies that are debt, because their debt has always got that inherent risk. Ideally, I avoid companies with debt of debt to equity more than 1. Then non-operating asset, that's okay. Then apart from that, there are set of companies which financial community like at a particular point in time. Obviously, because of the tailwinds and all of that. For example, today, financial community really like defense sector. They like data center, they like CDMO, right? So always there will be a few point in time where there will be a few sectors, themes that financial community will like, And because it is market in the short term is sentiment driven, you will see companies, those kind of companies generating high PE multiple. Of course, always remember market will always like a company that is a very strong governance, okay? And governance is something that is not easy to really understand, okay? That's very difficult. Just one more example I forgot to take. By the way, the company I was talking about earlier, this one, a market cap of 6 lakh crore, ROC is very low, but ROE is 19%. That's your Bajaj Finance. And again, remember, I've discussed it multiple times. In finance, NBFC, you cannot look at ROCE, you cannot look at debt to equity because they have the business where they borrow money and then they give it as loan. So this is a leverage based business. All finance and NBFC, you cannot look at your ROC, you cannot look at debt to equity, and you cannot look at PE ratio. What you should look? You should look at ROE, very, very important metric. What you should look? You should look at price to book for valuation. Bajaj Finance always command a premium valuation because it has one of the most pristine return on equity. Very few companies can have this kind of 19-20% ROE in finance category, and that is the reason it always command a premium. So this is just want to clarify on this, okay? Moving on, another very important parameter that decide market PE multiple or sector PE multiple or stock, and that is your interest rate. See, understand this very simple logic. If let's say today you get a 10% rate on FD, let's assume, would you put your money in your equity market? No, right? So the point is that when your interest rates are high, let's say it goes from 6% to 7, 8, and we are getting higher interest rate, your opportunity cost, like the money that you have invested in FD, generating 8% return versus a stock which is volatile, obviously you don't want to pay high P multiple to companies when your interest rates are high. When your interest rate fall, your opportunity cost fall. Let's say interest rate fall, FD rate fall from 8% to 6%. Now, would you keep your money in FD more or would you take a chance in equity? But in that case, obviously 6% is less. So you would want to move to equity and then you are willing to pay high P multiple, right? So rising interest rate would result in your fall in P ratio, and falling interest rate would result in your increase in P multiple. So recently, we were in a state of falling interest rate with RBI cutting down things, the rate and all, and your expectation was P would read, but then crude oil happened, and now the interest rate fall can pause, and that is the reason your derating can happen, right? So this is again a very interesting, important parameter. So I hope you got a fair idea which 8 parameters decide P ratio. It is, you can't just look at absolute number to say whether a company is cheap or not. And this is very, very important. I've shared this with example. So I hope it helps you in understanding better, like how do you really value a company. Now let's move on to the second part of this video, which is how do you identify stocks that are showing strength. Very simple metric. You don't have to do any rocket science. Just go to screener, type Nifty 50. Just look at the companies list here. If you don't have down, up, just edit column and add it. I already have added it. So just sort it. And this is the list of top 15 companies that are showing massive strength. Bharat Electronics, still trading at at all-time high. I'm not surprised. Why? Defense company, right? Bharat Electronics is clearly showing momentum. So likewise, what I've done is I've identified 15 such companies, okay? You've got Bharat Electronics, NTPC from power. Again, why power? Because energy is going to be very crucial, especially because of data center and AI. Then you've got Sun Pharma, very interesting. Titan is there, Bajaj Auto, JSW Steel, Coal India, Apollo, and likewise you've got few more companies. That's your Nifty 50. Likewise, I've identified Nifty Next 50. Okay, just sorted it. Torrent Pharma, ABB, TVS Motors, Siemens, Britannia, Vedanta. So these are the companies that are showing inherent strength. So if you want to invest your money, identify companies, top 15 from Nifty 50, 15 from Next 50, 15 from Mid Cap 150, and likewise 15 from Small Cap 250 and 15 from Micro Cap 250. I've already shown you how to do it. This will give you a solid understanding of what to buy, which companies are showing strength. And look at this, names. Belrise Industry, very interesting. Sterlite Tech. I'll come to Sterlite Tech, okay? This was a crazy, volatile business. Fell down significantly. Look at the crazy dump because it was an extremely commoditized business. But recently what has happened is because of AI data center demand for cables and fibers, actually, there's a massive more than 50%. In fact, the stock has doubled in less than 2 months. The stock has doubled. If you look at P ratio, you will go mad, right? You can't look at it. Price to sale is 2. But then the point I'm trying to make is there's something which fundamentally we have not identified, but technically it has shown a massive breakout. Again, I'm not saying that you go and buy it, but I'm trying to show you how companies, how when you track your stocks that are touching all-time high, they generate buying opportunity for those who want to buy momentum. Again, personally, I avoid having too much exposure in momentum. I am more inclined towards value. But I always say that you got to decide as an investor whether you are more inclined towards value, whether you are more inclined towards momentum. The problem with value is that a stock that has fallen from, let's say, 100 to 60, it can continue to fall to 40. It is still a value at 60, but then it can become deep value at 40, right? So if you buy it today, it may be in downturn and you may not like it. But then whenever the tide would turn, that 40 will become 100 and 200, right? The problem, the good part with momentum is that stock at 100 may be expensive, can become 150, right? And you feel good in the near term, but then you got to exit at right time. Otherwise, the moment tide would turn, that there will be a sharp correction, right? So these are the plus and minus. You got to decide how much percent you want in momentum, how much in value. That is absolutely an individual decision, right? Here in this particular video, I want to discuss companies that are still showing strength so that in the near term, right, if you buy it, they do not fall sharply. In fact, when the market rise, they are the first to jump. We have got Acuitas in this list as well. MTAR is there, TD Power is there, Dynamatics is there, Ether Industries is there, Sansera is there, Gujarat Ambuja, Seagull, KRN Heat Exchanger, Thangamalai, Anupam Rasayan CI. These are the micro cap companies, okay? What I've done is I have done a nice consolidation, like nice bucketing of these companies. Now, these are the companies that are showing strength, and this is a big list. Out of all these lists, look at the names: ABB, Siemens, Hitachi, Polycab. Just imagine, look at the crazy valuation. For example, Hitachi, by the way, I'm doing a deep video on data center, 2-part videos that will be live. One would be live today and another would be soon. So that you will give you a fair idea of what is the value chain of data center, where's the opportunity, and most important, the risk. Because there's a massive risk. The biggest risk is valuation. Not this company, Hitachi actually. Yeah, so Hitachi Energy, look at this. In spite of this weak market, company is trading all-time high. And that too when it commands a PE of 130. Now, if you look at PE ratio, you'll never have the courage to buy it, right? And sometimes you got to understand why market is paying a PE, such high PE, because data center is a massive, massive theme. Hitachi Energy is one of the most moated company. Okay, I'll discuss it in a YouTube video. Why? Because there are very few companies in the world that makes the kind of transformer it makes. Okay, so there's a value chain within that. It comes at the forefront with its transformer. The power that comes from power grid, which is massive voltage, 220 kilovolt. The job of Hitachi is to break that 220 volt into sub parts and then let it go into the compound of data center. So you've got many names. Polycab, KA. Polycab is one company that we have got in our list as well for 2026 stock list. Look at this strength that is showing, right? In spite of this weak market problem, P ratio. None of the company in this list is trading at reasonable valuation. That is the only catch. But they are all momentum plays. They can continue to do well as long as the data center theme is doing well. Look at TD Power. Fantastic company. Look at the growth. Excellent. But then valuations are not cheap. Like I said, none of the companies are cheap. RR Kabel is not exactly a data center theme. It's more of cable and wire for consumer space. But more or less, these are all companies. They are all solid companies, by the way. ABB India, an exceptional company. They're all, by the way, foreign companies. So ABB is the Indian subsidiary of Switzerland-based company. Likewise, Siemens is a Indian subsidiary of a German company. Hitachi is Indian subsidiary of Japanese company. Right? Cummins India is an Indian subsidiary of US company. The kind of innovation that they do there, Indian companies, they lack it, right? So anyways, so the point is data center is a massive theme. So these are specific data center companies that are showing strong momentum. If you want to play this theme, you can maybe pick 1 or 2 or 3 stock and consider allocating some money. Apart from this, power companies are also doing well. Power Grid, NTPC, GE Vernova. The reason is simple because you would need power, right? It has data center and everything that is happening today consumes massive power. What is the trigger? 650 billion of your spending by hyperscalers and AI race in 2026. It is getting crazy. Indian government is very clear. They want to make India a global hub of cloud and AI infra, and this data center and digital infra is just like building your roads and highways. And in fact, government is extremely bullish on this data center theme. They've given tax holiday till 2047. All hyperscalers, they don't have to pay any tax if they are building data center in India. Okay, then TCS has committed massive investment. Reliance Adani is committed $210 billion for AI infra, right? So this is a big theme. The only catch is valuations are not cheap across any of the company, okay? Apart from this, which other themes are looking very positive? Defense, no need to, no wonder, because A, structurally, there's a massive growth potential. B, because of what has happened recently, the war, obviously the defense companies are looking solid. The only catch, none of them are cheap. I really like data pattern, but then it is trading at a P of 78. What should you do? Like crazy growth. So it can continue to remain in momentum as long as you have this uncertainty, right? So if you want to play this in the near term, you can consider defense. CDMO, I've been saying this. Like, I don't want to deep dive. I've discussed it. Sai Life, Naveen Fluorine, Laurus Lab, Acuitas, great names. And the valuations are also, again, not cheap valuation, but decent, okay, as compared to the growth. Auto Auxiliary, you've got TVS Motor, Craftsman, Sunset are doing very well, showing a good strength. Banks, you've got Federal Bank, Karur Vysya, Axis Bank. And finally, you have a couple of capital market, not much, because at the moment, capital market is quite dull. You've got Anand Rathi and MCX. Right? So the idea is, again, you deep dive further, identify a few names if you want to build your momentum portfolio. And some of the companies from this theme can do well in the near term. Going forward, I think in the next video, what I'll do is I'll deep dive into a few specific companies where I'll look at the con call, I'll share insight. So maybe you can just also let me know a few of the companies which you want me to deep dive further, so that next video we'll discuss it. But yeah, that's it from my side for this video. I hope you'll find it useful. I'll see you next video. Till then, take care.